Happy Friday. Good morning and good afternoon, everyone. This is Jim and Anna with our little show, Live with Jim and Anna. How are you, Jim, this morning?
Excellent. It's really nice here in Maryland. Where are you at today?
I'm in my office in Burlingame, and the weather report is overcast and low 60s. How about
Oh,
that?
gee, sorry, Anna.
I know, but that's
Let's,
okay. It's Friday.
yes, let's get to some questions.
Let's get to questions. Oh, housekeeping before we get on to the questions.
Okay.
Our questions questions link is when you're looking at the screen is on the left-hand side at the bottom. So if you want to send us a question while we're live, please hit that link and we'll be ready to take your questions. So just a reminder, okay? But here's Jim. You want to go first?
Sure.
All right.
Go
So
ahead.
here's your first question. My high-income earning husband died at age 57. I am 62 now. I want to retire. Should I apply for Social Security widow's benefit, or should I take my own benefit?
Well, Anna and listeners and viewers, it depends. It depends upon what people's situation is. Traditionally, we've looked at your budget and we want to see how much income you need and what sources we're going to tap for that income and what the tax impact is and what the potential growth opportunity is. So if you calculate that the growth of your delayed work benefit until age 70 is a nice large number, then taking the widow's benefit probably makes sense to do it now at age 62. However, if you have a low work benefit, say $1,000 a month, it's probably not going to grow that much more than your widow's benefit if your late husband was a high income earner, and you could delay your widow's benefit until age 70. In that case, you take your work benefit now and you allow your widow's benefit to grow till age 70. In most cases that we've seen, we recommended taking the widow's benefit now, remembering that either of those benefits is still subject to an earnings test until you reach age 66 or 67, and we've told people to delay their work benefit until age 70 because the work benefit becomes a larger number and exceeded what the age 70 widow's benefit would have been. I hope that's clear.
Yes, that's very clear. Thank you, Jim. Are you ready for the next question, or you want to take a break?
Well, no, I'm not going to go two questions in a row. I've got one for you.
All right.
Should we take out our home equity line of credit, or just do a cash out refinance since we need $30,000 or so for an addition on the house?
Okay. This, if our listeners remember, this is a continuation on the discussion we had in our hangout last month, and so that's still the same kind of a situation. So now let's explore what are the options if we want to tap into either HELOC, home equity line of credit, or do a cash out refinance. So let me first discuss what the two options are, and then maybe we can conclude what would be the best solution. So I'm just going to go down and highlight what are the benefits of each. So when you take out a home equity line of credit, it's just a separate loan that sort of sits on the top of your first mortgage, or maybe you don't have a first mortgage. If you go the cash out refinance, what you basically are doing is you take it. Let's say, for example, you had a mortgage that was $100,000 and you needed to add $30,000 more to do this refinance. So you combine the two numbers and then you completely refinance that debt. So with that in mind, that already involves refinancing costs. Yes, you could argue that the rates are low, and I know that. Sure, they're very attractive. Our clients, just this week, we had one is getting a new mortgage, one is refinancing, so it's under 4%. So I like that, and it could go for 30 years, so you have more time to pay. But you have to look at what are the costs going in to refinance this amount. So it may not be as advantageous as just taking out a separate home equity line of credit. Yes, the rates might be the same or a little bit higher, and you have a little bit less time to pay. But remember, you only going to be paying interest on that 30,000 in our example. So the amount of debt is smaller. So I just thinking about what cash out refinance entails, and that's just a plain refinancing with an additional money taken out, and that there are closing costs. That already to me seems like not a very attractive option in today's environment. If you, for example, were doing a huge remodel in your house and you needed a couple $100,000 worth of funds, then maybe at that point that would have been a good example, a good route to go. So how about that, Jim?
Well, it always is a situation where the risk on the $30,000 interest rate, because it's a variable loan, in absolute dollars is really small. So I think the HELOC, I'd be leaning towards a HELOC for that amount of money.
Good. I'm glad you agree with me.
I always agree with you, Anna.
For once. No. Don't let's. Okay. All right. We'll just move on to the next question. Okay.
Is this your question or my question?
No, you're going next.
Okay. Thank you.
Okay. So here's your question. I have to take money out of my IRA, and I'm past 59 and a half. I have to pay taxes on my withdrawal. My custodian says I have a choice to do withholding of these taxes, or not to do it.
You know, that's really good that custodians give you an option, but the IRS does not give you an option without a penalty of interest due. Interesting. So the IRS code mandates that everybody pays their taxes on retirement distributions when they're dispersed, and most custodians offer at least federal withholding, and many of them offer state. I many times see the number and talking to clients or other people that they're doing 15% federal and 5% state withholding automatically, and that means the money showing up in their checking account is already had the taxes paid on it. If you don't have your custodian withhold, though, you take that other option, then you are obligated to make quarterly tax payments as income is received, whether it's from a retirement account or a sale of a property or a sale of a stock or a bond. So remember, in the case of retirement accounts, this money is really deferred compensation, and now that you're receiving it, the IRS in your state would like its fair share. So paying interest and penalties on your tax return is not a good strategy, and therefore I would lean towards having the custodian withhold, and even if it's only federal, and then doing a small quarterly payment to the state. That's my answer, and I'm sticking to it, Anna.
Okay. I will be checking on you, Jim, for that answer. Okay. We have one question that came through the chat, so let's get, we're doing good on time, so let's see if we can cover those. But let's, yes, go ahead.
Go ahead.
Go ahead with the, do you want to take on this question now in the middle?
It doesn't matter. I have a question for you, or we'll take the viewer question.
Okay. Let's take a viewer question, and then you can come back to me. So this one we can maybe answer jointly. So the question reads, why bother with rebalancing if my portfolio is throwing off plenty of income as is? It's just a risk management method, not a growth strategy. So if I can stand the risk, does it make sense to let it ride? So there's a couple of things here. Rebalancing is one aspect of it, and then the dividends is another. So the question is, at least in my mind right away, what are you doing with the dividends? Are you reinvesting them back into your portfolio, or are you keeping them in the money market fund? So if you are, then you could wait and not rebalance. If you're not, then we suggest you come talk to us. We'll take a look.
Well, it's always interesting, Anna, to see what slices of the pie are expanding or contracting, and over what percentage they are. And many times lately, in the last, say, year and a half, on rebalancing, most people's portfolio have not changed in the percentage of the large cap stock market or the small cap U.S. stock market or the emerging markets or real estate investment trust indexes. So as we look through people's portfolios, there hasn't been any dramatic shift. One of the things I have noticed, though, is technology as a sector is starting to rise in people's portfolio, and I think that's something that we need to be cognizant of, because many of those technology stocks have high betas, and beta means volatility, and so that's one of the things we look at Rebalance is how much volatility might be in your portfolio. And as people painfully learned in 2001, 2002, after the dot-com bubble burst, was having too much of a certain sector in your portfolio does present an unusual amount of risk. If it runs up fast, it's probably going to run down fast. And so the Chinese stock market felt that, and so people's portfolio, even by asset class, putting aside individual securities, could still run that kind of a risk.
Yeah. Our listener commented that he is actually reinvesting the dividends.
Well, if our listener is keeping the portfolio slices in reasonable percentages in relation to each other, then it's probably okay, and it's not introducing much more risk into the portfolio. Usually, if people get outside a 5% tolerance, in other words, emerging markets would go from 5 to 10%, then we definitely would be recommending a rebalance in that kind of a swing.
Right. I actually just last week, a few rebalances that I did, that was the area. The emerging markets was a little bit weak in these portfolios. But as you said, you're right. It's the accounts are mostly or the portfolios are mostly sticking to the allocation that we had recommended to our clients. It's just some of these asset classes that are just getting off track. Well, I hope this is enough comment on this question. If it's not, let us know if you have follow-up questions, and we have 2 more to go.
Okay, can I ask you a question then?
Yes, go ahead.
My question is in regard to the recent wave of panic selling due to the Chinese and Greek financial woes. Is it best to have an emergency fund account, or is that a separate question?
No, it's the same question.
Okay, is it best to have an emergency money fund account in a recipe with a greater amount percentage in bonds than stocks, or vice versa?
Well, Jim, I think I'm going to start with this, that emergency fund is not supposed to be invested in any of those. So my comment right away is emergency fund is just plain old, boring cash kind of account under the mattress. Stick it under the mattress so nobody can get to it. So FDIC insured money market account, high yield online savings account, one of those would be ideal, so that when you actually do read the news or watch the television or whatever it is, a coworker is mentioning to you that there was a big sell-off on the market today, it doesn't matter. Your portfolio or your emergency fund isn't affected by that. You always have it there. How about that?
I like it, and you know what we are usually recommending to our retired clients is 3 years worth of cash plus an emergency fund in bucket number 1, and you don't have to worry about the stock market. You can go to bed every night and sleep soundly because your withdrawals are coming from a safe source.
Right, and then to sort of tie in the question before that about the rebalance, so if there was or is happening a big sell-off in the market, and whatever parts of your portfolio are being unbalanced, that's when you think about, okay, well, maybe I do need to look into that rebalance, even though I have a strategy of reinvesting the dividends, and I have a strategy of how I'm putting my future additions into my portfolio, meaning they're all going in proportionately. So all these things are tied in together. Okay, well, we have a couple more minutes, Jim, and so this question was submitted on our comments right before we started, so let's take a look.
Okay.
We have most of our retirement resources in 401k plans, so we will be taxed upon withdrawal. Can a fixed immediate annuity or deferred income annuity be used to mitigate the tax bite? And if so, what are the advantages and disadvantages of either one or both?
Well, Anna, I'll take a stab at that.
Okay.
Okay. Money in retirement accounts, we'll call it deferred compensation. And up until age 70 and a half, the year you turn 70 and a half, it's not mandated that you take money out of those retirement accounts. But after that time, when you take a distribution, no matter in what form it is, it's going to be taxed as ordinary income. And so inside a retirement account, you can buy products like an annuity, an immediate annuity, which means that you give an insurance company a block of money and you start getting monthly checks, or a deferred annuity, which means you get a contract with the insurance company and you put money inside that annuity and it grows tax deferred, but it's already inside a retirement plan that's tax deferred. So when it comes time for mandated withdrawals, commonly known as a required minimum distribution, no matter what form the distribution takes, whether it's an annuity payment or it's just a withdrawal of cash, it's going to be taxed at the same ordinary income tax rates. So in my experience, I haven't seen any advantages of any kind of annuities inside a retirement account, because the insurance contract, one of the annuity's advantages, it compounds tax deferred. Well, inside a retirement account, it's already compounding tax deferred, so no advantage at that point.
But let's think a little further. So if in fact we were able to get taxable dollars, right, those savings outside of retirement accounts, and did go in fact find an annuity that we liked, for example, immediate annuity, then the taxation of that type of a annuity would give you some breaks as far as the taxes, because what happens is there's two parts to how the annuity or the payouts from the annuity are being taxed. So what you get as a payment is principal and interest, and so the principal comes out tax-free, so you're not paying taxes on that portion of the payout. And then you get interest, which is again taxed at ordinary income tax rate. So there is a little bit of savings in this strategy. But
our questionnaire had everything in retirement accounts, so that option wasn't available to them.
If that option, Jim, I said if that was an option.
Oh, okay. I'm just trying to answer the questioner's question.
Right. I think they understand, but okay, we'll let them tell us otherwise.
Okay.
Okay. No more questions come in our chat, so then we are going to conclude.
I think so. Time's up, Anna.
Okay, time's up, Jim. You talk too much. All right, everyone.
Thank you, Anna.
Happy Friday, and we'll see you next month. Bye, Jim.
Bye, everybody.